There is a single quote, a deceptively simple sentence, that acts as a master key to the mind of the most successful investor in history. It unlocks a way of thinking about business, money, and risk that is so profoundly counterintuitive, so radically different from the gospel preached in business schools and celebrated on the covers of magazines, that it feels like a secret. The man is Warren Buffett, and the quote is this: "I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later, one will." Think about that for a moment. Our entire culture is built on the worship of genius. We celebrate the visionary CEO, the charismatic founder, the turnaround artist who single-handedly saves a dying company. We are sold the story of the hero, the indispensable leader upon whose shoulders entire enterprises rest. And here is the Oracle of Omaha, a man whose life's work is the pinnacle of financial analysis and executive decision-making, telling us to search for the exact opposite. He's not looking for the business that needs a hero. He's looking for a business that true is the hero. A business so structurally sound, so fundamentally powerful, that it can not only survive, but thrive under the stewardship of mediocre management. This is the idiot-proof business test. It's not a cynical joke. It is the core of a sophisticated investment strategy designed to eliminate the single greatest hidden danger in any company: keyman risk. The risk that the entire edifice is built on the talent, vision, or connections of one single person. When that person leaves, retires, or makes a fatal mistake, the magic vanishes and the investment collapses. This is a lesson not just for those engaged in stock market investing, but for anyone involved in entrepreneurship, in building a business from the ground up. The goal isn't just to create a successful company. The ultimate goal is to create a resilient business, an asset that generates passive income and builds wealth as a function of its structure, not as a function of your constant, frantic effort. Today, we are not just going to admire this quote, we are going to deconstruct it, reverse engineer it, and turn it into a practical tool for your own financial analysis. We will build a complete mental model, a new lens through which you can evaluate any company, whether you're considering buying its stock, acquiring it outright, or building one just like it. We will explore the 5 fundamental pillars that hold up this concept of the idiot-proof business. We'll dive into the indestructible moats that protect them, the self-fueling engines that power their growth without needing a genius at the controls, the predictable customers who guarantee their revenue, the astonishing pricing power that makes them immune to inflation, and the rare corporate cultures that resist the suicidal urge to innovate themselves into oblivion. By the end of this journey, you will possess a powerful framework for stock selection and company evaluation that cuts through the noise of quarterly earnings and charismatic CEOs, allowing you to see the true, underlying strength of any business and embark on a more certain path toward your own financial freedom. Our first pillar, the very bedrock of the idiot-proof business, is the concept of an indestructible moat. A moat, in medieval times, was a deep, wide ditch filled with water surrounding a castle. Its purpose was simple: to protect the castle from attack. In business, a durable competitive advantage is the modern equivalent. It is a structural feature of the company that protects it from competitors, allowing it to maintain its profitability over the long term. A weak business is like a castle built on an open plain, vulnerable to any passing army. A truly great, idiot-proof business is a fortress surrounded by a wide, alligator-infested moat that competitors simply cannot cross. The beauty of a powerful moat is that it does the defensive work automatically. A mediocre manager, an idiot lord of the castle, doesn't need to be a brilliant military strategist if his fortress is simply unbreachable. The moat protects him from his own incompetence. There is no better story to illustrate this principle than one of Warren Buffett's most celebrated investments, a small, family-owned candy company that would become a cornerstone of his philosophy and a cash-generating machine for Berkshire Hathaway, See's Candies. The year was 1972. Warren Buffett and his partner, Charlie Munger, were presented with an opportunity to buy See's Candies. At the time, Berkshire Hathaway was still primarily a textile company, a terrible business that Buffett was desperately trying to escape. He was using the meager cash flows from the textile mill to buy into better businesses. See's was a California-based confectioner with a powerful regional brand, known for its high-quality, old-fashioned boxed chocolates. The company was being sold by the See family for $30 million. Buffett and his associate, Rick Guerin, took a look. The numbers were good. The company was earning about $4 million pre-tax. But the physical assets, the factories and stores, were only worth about $8 million. This created a problem. Buffett, a student of the legendary Benjamin Graham, was trained in the school of cigar butt investing, finding businesses trading for less than their liquidation value. You could buy them, take a final puff of profit, and discard them. See's Candies was no cigar butt. The asking price of $30 million was more than 3 times its tangible book value. From a classic value investing perspective, it looked expensive. Munger, however, saw something deeper. He saw the moat. He pushed Buffett to look beyond the simple numbers on the balance sheet. He argued that they were not just buying factories and inventory, they were buying an intangible asset of immense power, the See's brand in the minds of millions of Californians. For decades, See's had cultivated an image of quality and nostalgia. Giving a box of See's candies for Valentine's Day or Christmas wasn't just a transaction, it was a tradition. Customers would walk into the black and white checkered stores, greeted by friendly employees offering a free sample, and buy the same chocolates their parents and grandparents had bought. This emotional connection, this brand loyalty, was the company's moat. A competitor could build a new factory, they could hire candy makers, they could even try to copy the recipes. But they could not replicate the decades of happy memories and trusted quality associated with the See's name. That was the asset they were truly buying. Buffett, still hesitant about the price, was eventually convinced. Berkshire Hathaway acquired See's for $25 million. And what happened next became the foundational anecdote for the idiot-proof business model. The management of See's didn't need to be geniuses. They didn't have to invent a revolutionary new kind of chocolate or devise a complex global expansion strategy. Their primary job was to not mess things up. And one other thing, every year, after Christmas, they would have a conversation with Buffett and Munger about how much they could raise prices for the next year. And nearly every year, they raised them aggressively. Did customers revolt? Did they switch to cheaper brands? No, because when you're buying a gift for a loved one, the extra $1 or $2 for a trusted, beloved brand is an insignificant cost. The risk of disappointment from a cheaper, unknown alternative is far greater. The See's brand gave them pricing power, a topic we will explore in a later pillar. Over the years, See's Candies generated hundreds of millions, then billions of dollars in cash for Berkshire Hathaway, all while requiring very little additional capital investment. It was the perfect idiot-proof business. The moat, the brand, did all the heavy lifting. The managers simply had to maintain quality and open a few new stores now and then. The business ran itself, protected from competition by the intangible fortress of customer loyalty. This experience fundamentally changed Buffett's approach to investing. It shifted him from Ben Graham's cigar butts to finding wonderful businesses at a fair price. He learned that the most valuable asset a company can have, the true source of a durable competitive advantage, often doesn't even appear on the balance sheet. So why does a moat like the one protecting See's Candies work so well? What is happening on a cerebral level that makes a customer walk past 10 other brands of chocolate to buy that specific one, year after year, even as the price creeps up? The answer lies in a fundamental concept of behavioral science, the 2 systems of human thinking, popularized by the psychologist Daniel Kahneman. Our brain operates on 2 distinct frequencies. System 2 is our slow, deliberate, analytical mind. It's the part of you that solves a math problem, weighs the pros and cons of a major life decision, or performs a detailed financial analysis of a company. It's logical, but it's also lazy and energy-intensive. System 1, on the other hand, is fast, intuitive, and emotional. It's the part of your brain that recognizes a friend's face in a crowd, gets a gut feeling about a situation, or drives a familiar route home on autopilot. It operates automatically and quickly. With little or no effort, and no sense of voluntary control. The vast majority of our daily decisions are made by System 1. It uses mental shortcuts or heuristics to navigate the world efficiently. An indestructible moat is a business structure that is built to appeal directly to System 1, effectively bypassing the rational, price-sensitive calculations of System 2. Let's look at the See's Candies brand moat through this lens. When a customer thinks about buying a box of chocolates for a special occasion, they are not typically engaging in a System 2 analysis. They are not creating a spreadsheet comparing the price per ounce, cocoa content, and customer reviews of every available brand. That would be exhausting. Instead, their System 1 brain takes over. It rapidly scans for a familiar, trusted solution. A powerful brand is a System 1 shortcut. The See's logo instantly triggers a cascade of mental associations: quality, tradition, nostalgia, safety. It's the no-brainer choice. The decision is made emotionally and automatically. This is the power of habit and brand association. Companies with strong moats have successfully embedded themselves into the habitual loops of their customers. Think of Coca-Cola. When you're thirsty on a hot day, the thought "Coke" can pop into your head unbidden. That is System 1 at work. Think of Google. When you have a question, you don't rationally consider all the available search engines. The verb "to Google" is a System 1 default action. These moats work by reducing the cognitive load on the consumer. They make the choice easy. An idiot manager could change the advertising campaign, but they can't easily erase decades of ingrained habit in millions of customers. The behavior is sticky. Another type of moat, high switching costs, plays on a different but related psychological principle: loss aversion. Loss aversion is our tendency to feel the pain of a loss about twice as strongly as the pleasure of an equivalent gain. Switching from your bank, your company's accounting software, or your mobile phone provider involves a guaranteed hassle, a certain loss of time and energy. The potential gain from switching to a competitor has to be significantly large to overcome that guaranteed pain. Therefore, you stick with what you have. The company is protected by your inertia. The manager doesn't have to be a genius. They just have to avoid making the service so terrible that the pain of staying becomes greater than the pain of switching. The moat, in this case, is a psychological barrier built on laziness and loss aversion. The idiot-proof business, then, is one that has successfully offloaded the work of customer retention from its management to the cognitive biases of its customers. Translating this powerful theory into a practical tool requires a structured approach. Let's build the blueprint, the applied mental model, for identifying an indestructible moat. This is a step-by-step process you can use in your own business analysis to determine if a company truly has the fortress-like structure that Buffett seeks. It's a way to move from abstract concepts to a concrete company evaluation. Step 1. Identify the species of moat. Not all moats are the same. You must first diagnose what kind of competitive advantage, if any, the company possesses. The most common species are the brand moat, like See's Candies or Apple, where customers pay a premium for a trusted name. The switching moat, like your bank or Microsoft Windows, where the cost and hassle of leaving are too high. The network effect moat, like Facebook or Visa, where the service becomes more valuable as more people use it, creating a winner-take-all dynamic. The cost advantage moat, like Costco or Geico, where the company's scale or processes allow it to offer its product or service at a significantly lower cost than competitors. And finally, the intangible asset moat, which includes things like patents for a pharmaceutical company or government licenses for a utility. Your first task is to look at the business and ask, why do customers choose them, and why is it difficult for a competitor to steal those customers? If you can't articulate a clear answer, there probably isn't a moat. Step 2. Test the moat's durability. A moat is only valuable if it is durable. A hot new restaurant has a temporary advantage, but it's not a durable one. The key question here, a classic Buffett and Munger query is, will this advantage still be as powerful in 10 or 20 years? This question forces you to think about the pace of change in the industry. The moat around Wrigley's chewing gum, a simple, unchanging product, is likely to be far more durable than the moat around a cutting-edge semiconductor company, where a technological shift can render its advantage obsolete overnight. An idiot-proof business must have a moat that can withstand the test of time, not just the current market cycle. Step 3. Quantify the moat's strength. A moat isn't just a feeling. It manifests directly in a company's financial statements. This is where your financial analysis skills come in. The clearest indicator of a strong moat is consistently high gross profit margins. Gross margin, revenue minus cost of goods sold divided by revenue, tells you how much profit the company makes on each sale before administrative costs. A company with a powerful moat can charge a premium price, leading to fat margins. Compare the company's gross margins to its competitors over a 10-year period. If they are consistently higher, you've found evidence of a real competitive advantage. Another key metric is return on invested capital, or ROIC. This measures how effectively a company is using its money to generate profits. Businesses with strong moats tend to have very high and stable ROIC because their protective barrier allows them to earn outsized profits without having to constantly reinvest massive amounts of capital. Step 4. The ultimate idiot test. This is the final, qualitative check. Ask yourself this simple, brutal question. Could a new, spectacularly incompetent CEO come in and permanently damage this competitive advantage within 1 or 2 years? If the answer is yes, then the moat is not truly indestructible. A bad CEO at a high-tech firm could miss one product cycle and destroy the company. A bad CEO at a fashion brand could misread a trend and become irrelevant. But could a bad CEO at Coca-Cola permanently destroy the world's desire for a cold, sweet, fizzy drink? Could they erase a century of brand building in 2 years? It's highly unlikely. The business itself is so robust that it can absorb a tremendous amount of managerial folly. When you find a business that passes this final test, you have found the kind of fortress Buffett is looking for. To truly appreciate the wisdom of seeking out indestructible moats, we must examine the alternative path. The path trodden by the 99% of investors and entrepreneurs who are seduced by stories of genius and growth at any cost. This is the path of investing in businesses with fragile, temporary advantages, or worse, no advantage at all. The antithesis of the idiot-proof business is the key man risk company. This is a business that appears brilliant on the surface, often led by a charismatic, visionary founder or a superstar CEO. The stock price soars, the media fawns, and investors pile in, believing they have found the next great thing. But the entire enterprise is a castle made of sand, its success precariously balanced on the abilities of one person. The moment that key person leaves, falters, or the narrative they've spun collapses, the business is exposed as fundamentally weak. Think of the countless story stocks in the tech sector. A brilliant founder develops a groundbreaking piece of software, and the company experiences explosive growth. Investors aren't really buying the software, they're buying the founder's vision. They are betting on the genius. The company's stock selection narrative is all about the leader's next move. But what happens if that founder is poached by a larger competitor? Or gets burned out and decides to retire to a private island? Or, as is so often the case, their first brilliant idea is followed by a series of mediocre ones. The company, which never developed a true structural moat, begins to flounder. Its success was rented, not owned. Another classic example is the turnaround artist scenario. A company is failing, and a new hotshot CEO is brought in. They slash costs, sell off bad divisions, and for a couple of years, the company's profits miraculously recover. The stock price triples. The CEO is hailed as a savior on the cover of business magazines, but often they haven't actually fixed the underlying business. They haven't built a moat, they've simply squeezed the last bit of juice from a dying orange. Once the easy cuts are made and the one-time financial engineering is done, the company's fundamental lack of a competitive advantage reasserts itself and it sinks back into mediocrity. Those who invested at the peak of the hero worship narrative are left holding the bag. The path of the 99% is paved with these kinds of businesses. They are exciting, they make for great stories, but they are terrible long-term investments. They require constant vigilance and a perfect execution of strategy. An idiot cannot run them. In fact, even a genius can only run them successfully for a short time before the brutal reality of competition erodes their profits. This focus on leaders rather than business structure is a fatal flaw in most people's investment strategy. They chase performance, they chase narratives, they chase personalities. Buffett's genius is in his deliberate inversion of this approach. He's not trying to predict who the next genius CEO will be. He's trying to find a business so fundamentally strong that the identity of the CEO is almost a secondary consideration. This is a far more reliable and less stressful path to building long-term wealth. The financial connection here is direct and profound. The existence of an indestructible moat isn't an abstract academic concept. It is a tangible force that shapes a company's financial statements and dictates its long-term value creation. When you learn to see moats, you learn to read the story behind the numbers on a balance sheet and income statement. Let's start with the income statement. As we mentioned, a powerful moat, especially a brand-based one, grants a company pricing power. This manifests as consistently high and stable gross profit margins. While a company in a fiercely competitive industry might see its margins squeezed every time a competitor runs a sale, the company with a moat can protect its profitability. This flows down the income statement. Because they don't have to engage in value-destroying price wars, their operating margins are also protected. They can afford to spend on marketing and research not out of desperation, but from a position of strength, further widening their moat. Next, look at the balance sheet. A company with a moat often has a surprisingly light asset base. See's Candies didn't need massive, capital-intensive factories to maintain its advantage. Its real asset was its brand, which is an intangible. This leads to an incredibly high return on tangible assets. This financial ratio tells you how much profit the company generates for every dollar of physical stuff it owns. For moat-protected capital-light businesses, this number can be astronomical. This is a direct measure of the business's efficiency and a clear sign that you're not looking at a commoditized, capital-guzzling enterprise. Finally, and most importantly, consider the statement of cash flows. A business with a durable competitive advantage is a cash-generating machine. Because it has high margins and often low capital requirements, it produces a torrent of free cash flow, the cash left over after all expenses and investments have been paid. This is the lifeblood of value investing. This cash can be returned to shareholders through dividends and buybacks, or it can be used to acquire other wonderful businesses, creating a compounding effect. A company without a moat is constantly fighting for survival, reinvesting every dollar it earns just to keep its head above water. A company with a moat is a financial fortress, stacking up piles of cash year after year, regardless of whether the person in the corner office is a visionary or just a caretaker. This is the ultimate financial advantage, the end goal of the idiot-proof business test. It's the structure that leads to true passive income and sustainable, long-term stock market investing success. The second pillar supporting Buffett's idiot-proof framework is what we can call the self-fueling engine. This refers to a business that not only generates high profits but does so with an exceptionally low level of capital investment. Think of it this way. Some businesses are like a high-performance race car that requires a team of genius mechanics and a constant infusion of expensive parts just to keep running. Others are like a simple, magical goose that lays golden eggs every day, asking for nothing but a handful of feed in return. Buffett wants to buy the goose, not the race car. A business that constantly requires massive capital expenditures to stay relevant or competitive is a business that presents countless opportunities for a bad manager to make a catastrophic mistake. They can invest in the wrong technology, build a factory in the wrong location, or overpay for a massive upgrade. A business that requires very little capital, on the other hand, is inherently more resilient. The profits it generates are free and clear, able to be allocated rationally. rather than being automatically plowed back into a potentially low-return operation. The idiot manager in charge of the golden goose has fewer decisions to make, and therefore fewer chances to screw up. The business essentially fuels itself. To truly understand the power of this concept, we must travel back to 1977, to a time before Buffett was a global icon, when he was still building his empire one brilliant investment at a time. The foundational anecdote here is not a charming candy company, but a gritty, unglamorous newspaper in upstate New York, the Buffalo Evening News. The newspaper industry in the mid-20th century had a peculiar and wonderful economic characteristic: if you owned the right paper in the right town. In most cities, there was only room for one profitable newspaper. The dominant paper became the town's central hub for information, advertising, and classifieds. This created a local monopoly, a powerful moat. Once a paper achieved this dominant position, its economics became spectacular. It had pricing power, with advertisers who had nowhere else to go. But most importantly for our current pillar, once the printing press and the building were paid for, the business required very little additional capital investment to maintain its dominance. It was a self-fueling engine that gushed cash. In 1977, Buffett's Blue Chip Stamps, one of his holding companies, bought the Buffalo Evening News for about $32.5 million. At the time, Buffalo had two papers, but the Evening News was the stronger of the two, especially its weekend edition. Buffett then launched a Sunday edition to compete directly with his rival's main cash cow. A brutal newspaper war ensued. It was a messy, expensive fight that involved lawsuits and accusations of anti-competitive practices. For a time, the Buffalo Evening News was losing money. From the outside, it might have looked like a risky gamble. But Buffett understood the underlying economics of the business. He knew that if he could win the war and become the sole surviving paper, he would own a magnificent economic asset. And that's exactly what happened. In 1982, the rival paper, the Courier Express, shut down for good. Overnight, the Buffalo Evening News, renamed the Buffalo News, became a monopoly. And the financial results were staggering. In the years that followed, the newspaper generated tens of millions of dollars in profit annually, and the key part: it required almost no new capital. The printing presses were already there. The distribution network was established. The profits it produced were pure, unadulterated free cash flow. This single, unglamorous business became one of the primary financial engines for Berkshire Hathaway's growth in the 1980s. The cash that flowed out of Buffalo was used to buy shares in Coca-Cola, the Washington Post, and other wonderful businesses. An idiot could have run the Buffalo News after 1982. The job was simple: print the paper, sell the ads, and cash the checks. The business model itself, a capital-light local monopoly, was so powerful that it didn't require a genius manager. It just needed a caretaker. This experience solidified a core tenet of Buffett's investment strategy: search for businesses that don't just have a moat, but that can maintain that moat without constantly having to spend a fortune rebuilding the castle walls. Search for the self-fueling engine. What is the underlying psychological mechanism that makes capital-light businesses so superior, and why do so many managers and investors fall into the trap of capital-intensive ones? The answer lies in a pair of powerful cognitive biases: the endowment effect and the status quo bias. The endowment effect describes our tendency to overvalue things simply because we own them. In a famous experiment, participants were given a coffee mug and then asked how much they would sell it for. Their asking price was consistently about double what a separate group of participants, who were not given a mug, were willing to pay for it. Mere ownership infused the object with extra value. The status quo bias is a related preference for the current state of affairs. Any change from the baseline is perceived as a loss. Now imagine you are the CEO of a large capital-intensive business, like an airline or a steel manufacturer. You are endowed with billions of dollars worth of airplanes or factories. The endowment effect will cause you to psychologically overvalue these assets. The status quo bias will make you resistant to shutting down an underperforming factory or selling off an old fleet of planes because that would be a painful change from the current state. When the company generates some cash, what is the easiest, most psychologically comfortable thing to do? It's to reinvest that cash right back into the business you already own and understand, buying new planes, upgrading the factories. Even if the returns on that new investment are projected to be pitifully low, the institutional imperative and these cognitive biases push you to feed the beast. It's the path of least resistance. You are trapped. The business doesn't produce free cash, it consumes capital just to stay in the game. Buffett actively seeks to avoid this trap. A business like the Buffalo News or See's Candies that requires little additional capital breaks this psychological cycle. The cash it generates is truly free. It isn't mentally earmarked for more of the same. It can be viewed as a separate pile of money ready to be deployed into whatever opportunity offers the highest return, whether that's buying back its own stock or investing in a completely different industry. The manager of a capital-light business is liberated from the psychological prison of reinvesting in low-return assets. An idiot manager in this scenario might just let the cash pile up on the balance sheet, which is a suboptimal but not a catastrophic decision. An idiot manager in a capital-intensive business driven by the need to do something can destroy billions of dollars of shareholder value by investing in projects that will never earn a decent return. The self-fueling engine isn't just an economic model. It's a structure that protects a company from the value-destroying psychological biases of its own management. How can you, as an investor or entrepreneur, systematically identify these self-fueling engines? You need a practical checklist, an applied mental model to sift through companies and find the ones that don't just earn money, but gush free cash. Let's call it the Capital Light Checklist. Step 1. Analyze the statement of cash flows. This is the most important financial document for this pillar. Ignore the net income on the income statement for a moment. It can be misleading. Go straight to the cash flow statement and look for two numbers: cash from operations, CFO, and capital expenditures, CapEx. CFO is the cash the business generates from its normal operations. CapEx is the money it spends on long-term assets, like buildings and equipment. A self-fueling engine will consistently show CapEx as a small percentage of its CFO. For a truly magnificent business, it might be less than 25%. This tells you that the company doesn't have to spend much of its incoming cash just to maintain its operations. The rest is free for other uses. Step 2. Calculate the return on tangible assets. We touched on this before, but it's crucial here. Take the company's pre-tax earnings and divide it by its tangible assets. Total assets minus intangible assets like goodwill. A high and consistent number here is a powerful indicator. It shows that the business doesn't need a lot of physical stuff to generate its profits. Its value comes from an intangible, like a brand or a patent, which doesn't require constant, expensive upgrades. This is a key part of any serious financial analysis aimed at finding resilient businesses. Step 3. Apply the growth versus maintenance test. This is a more qualitative assessment. Try to determine how much of the company's CapEx is for maintenance versus growth. Maintenance CapEx is the spending required just to keep the business running at its current level, e.g., replacing old delivery trucks. Growth CapEx is the spending on new projects to expand the business, e.g., building a new factory to enter a new market. A great, idiot-proof business has very low maintenance CapEx. Its existing operations are like a perpetual motion machine. While growth is good, it also introduces risk. A business that must constantly spend heavily on new growth projects is a business that is constantly giving its managers opportunities to make big mistakes. The ideal scenario is a business that requires little maintenance and can grow using its brand or network effect, without massive capital outlays. Step 4. Scrutinize the debt load. Self-fueling engines rarely need to take on large amounts of debt. Because they fund their own minimal needs from their operating cash flow, Their balance sheets are often pristine, with lots of cash and very little debt. A company that is constantly borrowing money is a red flag. It suggests that the business itself is a cash drain, not a cash source. It is the opposite of a self-fueling engine. By running a company through this four-step checklist, you can get a clear picture of its capital dynamics and avoid the kind of businesses that are a constant drain on shareholder resources. The path of the 99% leads directly into the maw of capital-intensive industries. These are the businesses that look impressive and important, but are often terrible long-term investments. The classic antithesis of the self-fueling engine is the airline industry. And ironically, Warren Buffett himself provides the perfect cautionary tale. Early in his career, Buffett made what he would later call one of his biggest mistakes. He bought preferred stock in U.S. Air. He was lured by the apparent growth of the industry and what seemed like a safe, high-yielding security. But he quickly learned a brutal lesson about the economics of airlines. An airline is a quintessential capital-guzzling machine. It requires a massive upfront investment in airplanes which are incredibly expensive and have a limited lifespan. They require constant, costly maintenance. The industry is subject to intense, cutthroat competition on price. A new, low-cost competitor can enter a route and immediately drive down profits for everyone. The business is also at the mercy of external factors it can't control, like the price of jet fuel and the strength of the economy. The result is a business that, even in good times, has to reinvest almost all of its earnings back into the company just to stay competitive. It needs to constantly buy new, more fuel-efficient planes to keep up with rivals. There is no lasting competitive advantage. The moat is non-existent. The business doesn't generate free cash, it incinerates it. Buffett famously quipped, "If a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. He would have saved his descendants a lot of money." The airline industry is a perfect example of a business that can only be run by geniuses, and even then, it's a constant struggle. An idiot manager in an airline can bankrupt the company in a single quarter by buying the wrong planes or expanding into the wrong routes at the wrong time. There is zero margin for error. The 99% of investors are drawn to industries like this because they are visible, they are growing, and they seem essential to the modern economy. They mistake revenue growth for value creation. They don't look under the hood at the statement of cash flows to see the horrifying rate at which the business consumes capital. They are buying the race car, impressed by its speed and glamour, without realizing that the maintenance bills will eat them alive. Buffett's genius was in learning this lesson and then rigorously applying it, searching only for the golden geese and leaving the flashy, high-maintenance race cars for others to own. The direct financial connection of the self-fueling engine principle is perhaps the most powerful in all of value investing. It all comes down to one metric: owner earnings, or its more common proxy, free cash flow, FCF. Free cash flow, calculated as cash from operations minus capital expenditures, is the single most important number for determining the true value of a business. It represents the real cash profit that the business generates, which is available to be distributed to its owners, the shareholders. A company's stock is ultimately worth the discounted value of all the cash it can produce for its owners over its lifetime. Therefore, a business that generates a high and growing stream of FCF is inherently more valuable than a business that generates high net income but very little FCF. Let's trace the impact. A business with a self-fueling capital-light structure will have a huge FCF number relative to its net income. Where does this cash go? Management has several choices, and even an idiot manager will likely stumble into a value-creating one. They can pay it out as a dividend, providing a direct cash return to shareholders. This is a core component of many passive income strategies. They can use it to buy back their own shares. This is an incredibly powerful tool. By reducing the number of shares outstanding, each remaining share becomes entitled to a larger percentage of the company's future profits, increasing earnings per share and driving the stock price up over time. Or they can let the cash accumulate on the balance sheet, building a fortress of financial strength that allows the company to weather any economic downturn and pounce on opportunities when others are fearful. This financial flexibility is an enormous competitive advantage. Contrast this with the capital-intensive company. Its FCF is meager or even negative. It can't pay a sustainable dividend. It can't afford to buy back shares. In fact, it may even have to issue new shares to fund its capital needs, diluting existing shareholders and reducing their ownership stake. Its balance sheet is loaded with debt taken on to pay for its expensive assets. It has no financial flexibility. It is fragile. When you are engaged in stock selection, learning to prioritize businesses with high and growing free cash flow is like putting on a pair of X-ray goggles. You can suddenly see through the accounting fictions of net income and perceive the true underlying economic engine of the company. This is the financial manifestation of the idiot-proof business, a structure so powerful that it produces cash almost automatically, waiting to enrich its owners. The third pillar of the idiot-proof business is the one that is perhaps most overlooked in our modern obsession with disruption and innovation. It is the principle of the predictable customer, which leads to the ideal of a simple, unchanging product. If the business sells something that people need or desire consistently, and the product itself rarely changes, you remove another major source of potential managerial error. The CEO doesn't have to be a visionary who can predict the next big trend. They don't have to place huge bets on unproven technologies. The business is anchored in the solid ground of stable, predictable human behavior. An idiot manager is far less likely to destroy a business where the core task is simply to keep producing the same thing that worked last year and the year before that. The product and the customer's desire for it are the constants that provide a powerful stabilizing force, protecting the company from strategic blunders. There is no company on earth that embodies this principle more perfectly than Coca-Cola, one of Warren Buffett's largest and most famous investments. The story of his investment is a masterclass in appreciating the power of a simple, unchanging product with a global army of predictable customers. By the late 1980s, Buffett had fully evolved from his cigar butt roots and was squarely focused on buying wonderful businesses. He had been a consumer of Coca-Cola products his entire life. He famously drinks several cans a day. He understood the product on a gut level. But it was the stock market crash of 1987 that gave him the opportunity to invest on a massive scale. In the panic that followed Black Monday, even the shares of the highest quality companies were thrown on the bargain pile. Buffett saw his chance. Between 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a substantial stake in the Coca-Cola Company. What did he see that others, in their panic, were missing? He saw a business of breathtaking simplicity and power. The core of Coca-Cola's business is not bottling plants or delivery trucks. It is the sale of a secret syrup concentrate to a global network of bottlers. It is an incredibly capital-light, high-margin business, a perfect self-fueling engine. But the true genius lies in the product itself. The taste of a classic Coke is a constant in a rapidly changing world. The product sold in 1988 was essentially identical to the one sold in 1958 and 1928. Buffett could look at this business and, with a high degree of certainty, predict that people all over the world would still be drinking vast quantities of it in 10, 20, even 50 years. The customer was predictable. The desire for a cold, sweet, refreshing beverage is a basic human impulse. Coca-Cola had simply attached its brand to that impulse more successfully than any company in history. There is a fascinating and crucial chapter in the company's history that actually proves its idiot-proof nature: the New Coke disaster of 1985. In a stunning act of managerial hubris, the company's executives decided to change the sacred formula for the first time in 99 years. It was a decision driven by market research and a desire to innovate. the public reaction was swift and violently negative. There were protests, boycotts, and thousands of angry letters and phone calls. The company had fundamentally misunderstood its relationship with its customers. People didn't just drink Coke. They had an emotional connection to it. It was a piece of their lives. After just 79 days, the company capitulated and brought back the original formula, rebranded as A. This event, which at the time seemed like a colossal blunder, was actually the greatest marketing experiment in history. It demonstrated that the business was more powerful than the managers running it. The predictable customers themselves rose up and forced the company back onto the correct path. They literally saved the executives from their own idiocy. This is the ultimate proof of an idiot-proof business, one where the customers will not even allow you to destroy it. It was this profound stability that Buffett was buying into, a business anchored not in brilliant strategy, but in the simple, predictable, and fiercely loyal habits of billions of people. The psychological principle that underpins the power of the unchanging product is a concept known as the Lindy effect, supplemented by our innate preference for the familiar. The Lindy effect is a theory of longevity which proposes that for certain non-perishable things, like a technology, an idea, or a brand, every day they survive increases their future life expectancy. For example, a play that has been performed for 100 years is more likely to be performed for another 100 years than a new play that has been running for only 1 week. The same is true for products. A product like Coca-Cola, which has been a market leader for over a century, has demonstrated a resilience and staying power that makes it a far safer bet for the future than a trendy new energy drink that has only been on the market for a year. The Lindy effect suggests that its past longevity is a direct indicator of its future durability. It has survived wars, depressions, and countless technological and cultural shifts. This is the opposite of how we usually think about the world, where we assume that what is old is destined to be replaced by what is new. For foundational consumer products, the opposite is often true. This works in concert with a basic human preference for the familiar. While we are sometimes drawn to novelty, a trait called neophilia, a more powerful and fundamental drive is a comfort with what we know. The familiar feels safe. When we are in a supermarket, faced with a wall of choices, reaching for the familiar brand is a low-energy, low-risk decision. It's a System 1 shortcut. Companies with simple, unchanging products have had decades to embed themselves in our cultural consciousness and our daily habits. They become the default choice. The manager of such a business doesn't need to be a genius at product development. Their job is to be a good steward of a product that is already deeply entrenched. They must resist the urge to tamper with a winning formula. The institutional imperative to innovate and disrupt is actually the greatest threat to these businesses. The new Coke fiasco is the perfect example of managers trying to be clever and innovative, and in doing so, nearly destroying the very foundation of their success. An idiot-proof business leverages the Lindy effect and our preference for the familiar. It has a product that has stood the test of time, and it relies on customers whose habits are deeply ingrained. This creates a powerful and predictable revenue stream that is remarkably resilient to both external shocks and internal mismanagement. To turn this into a practical tool for business analysis, we can create an applied mental model called the unchanging product scan. It's a series of questions to ask yourself when evaluating a company's core offering. Step 1. The 20-year test. This is a simple but powerful thought experiment. First, look back 20 years. Would you have understood this company's product and how it made money back then? For Coca-Cola, Wrigley's Gum, or Heinz Ketchup, the answer is a definitive yes. For a complex software or biotech company, it's a maybe at best. Second, and more importantly, look forward 20 years. Can you say with a high degree of confidence that the company will be selling essentially the same product or service to a similar customer base 2 decades from now? If the answer is yes, you are looking at a business with a potentially very durable and predictable future. This is a core tenet of long-term value investing. Step 2. The explain it to a child test. Can you describe what the business does and how it makes money in a single, simple sentence that a reasonably intelligent child could understand? They sell sugary brown water to thirsty people all over the world. They sell candy bars with caramel and nougat. They rent out cars to people who are traveling. This is a test of business model simplicity. If a company's business is so convoluted that it requires a lengthy explanation full of jargon, it is likely a business where many things can go wrong. Simplicity is a hallmark of resilience. An idiot manager can operate a simple business. A complex business often requires a genius just to keep it from collapsing under its own weight. Step 3. Analyze the customer's motivation. Why are customers buying this product? Is it out of deeply ingrained habit, like a morning coffee from Starbucks? Is it a recurring necessity, like toothpaste? Is it a simple, affordable pleasure, like a chocolate bar? These are highly durable motivations. Contrast this with products bought to follow a fleeting trend, like a piece of high-fashion clothing, or products that rely on having the absolute latest technology, like a smartphone. These motivations are fickle. The customers are not predictable. They are constantly looking for the next best thing. A business built on habit, necessity, or simple pleasure has a much more stable and predictable customer base, making it inherently less risky and easier to manage. Applying this three-part scan helps you filter out the exciting but fragile businesses and focus on the boring but incredibly durable ones that form the foundation of an idiot-proof portfolio. The antithesis to the predictable customer and the simple product is the company that lives on the bleeding edge of technology or on the fickle whims of fashion. This is the path of the 99%, chasing the excitement of constant innovation and disruption. These businesses are the polar opposite of idiot-proof. They are what you might call genius-dependent. Consider the high-tech hardware industry, specifically the history of the smartphone. Companies like Nokia and BlackBerry were once titans of the industry. They were innovative, profitable, and seemingly invincible. Nokia dominated the global mobile phone market. BlackBerry, with its iconic keyboard and secure messaging, was the indispensable tool of business and government. They had brilliant engineers and, for a time, brilliant management. But their products were not simple or unchanging. They were locked in a relentless technological arms race. Their survival depended on their ability to constantly predict the future and execute flawlessly on the next product cycle. Then, in 2007, Apple released the iPhone. It was a paradigm shift. Suddenly, the game wasn't about call quality or battery life. It was about touchscreens, apps, and the mobile internet. Nokia and BlackBerry, for all their past genius, failed to adapt quickly enough. Their management, which had seemed so brilliant just years before, was made to look like fools. Their competitive advantages, which were based on scale and specific technologies, proved to be terrifyingly brittle. Within a few short years, these giants were brought to their knees. An idiot could not have run Nokia in 2007. In fact, even the very smart people who were running it failed catastrophically. The business was simply too difficult, the pace of change too rapid. The same is true for the fashion industry. A brand can be the hottest thing in the world for one season, but if its designers misjudge the trends for the next season, it can become irrelevant overnight. Success is fleeting. It requires a constant stream of creative genius. The 99% of investors are drawn to these industries because they are exciting and offer the potential for explosive growth. But they are playing a very difficult game. They are betting on a company's ability to win an endless series of sprints. Buffett's approach is to bet on the tortoise, the company that is built to win a marathon through sheer endurance and predictability. He is looking for a business where the future looks a lot like the past, a landscape where an idiot manager can't get too lost. The direct financial connection of this pillar is found in the concept of predictability and low volatility. A business with a simple, unchanging product and a predictable customer base will have financial statements that are, for lack of a better word, boring. And in the world of long-term investing, boring is beautiful. Look at the income statement. A company like Coca-Cola or Procter & Gamble will exhibit remarkably stable revenue growth. There are no wild swings, no bet-the-company product launches that lead to a huge spike one year and a crash the next. The growth is steady, methodical, and predictable. This allows for much more accurate long-term financial planning and a more reliable valuation of the business. Another key financial indicator is the amount spent on research and development, R&D. A technology or pharmaceutical company must spend a massive percentage of its revenue on R&D just to stay in the game. This is a risky and uncertain investment. A company selling soap or soda, on the other hand, spends very little on R&D. Their product is already perfected. This low R&D spending means more of their revenue flows directly down to the bottom line as profit. It is a more efficient and less risky business model. On the statement of cash flows, this stability translates into highly predictable operating cash flows. This predictability is invaluable for any entrepreneur or investor trying to build a stream of passive income. You can rely on the dividend from a company like this because its underlying business is so stable. It's not a speculative bet. It's a share in a durable, cash-producing enterprise. Ultimately, the financial advantage of investing in these kinds of businesses is a reduction in risk. The probability of a permanent loss of capital is dramatically lower in a business with a predictable future than in one that is constantly reinventing itself. This is a cornerstone of sound wealth management and a critical component of building a truly resilient, long-term investment portfolio. This brings us to our fourth pillar, which is the ultimate test of a company's competitive advantage and a direct consequence of the first three pillars we've discussed. It is the power of pricing power. Pricing power is a company's ability to raise its prices over time without losing significant business to a competitor. It is, in Buffett's own words, the single most important decision in evaluating a business. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 10%, then you've got a terrible business. A business with true pricing power can protect itself from inflation, expand its profit margins, and absorb the occasional managerial mistake. It is an indispensable feature of an idiot-proof enterprise because even a clueless manager can understand the simple instruction, "This year, we're charging 5% more." One of the most dramatic stories from Buffett's career that illustrates this concept is his investment in American Express during the Great Salad Oil Scandal of 1963. It was a moment of crisis that would have destroyed a lesser company, but Buffett, through his brilliant business analysis, saw that American Express's core pricing power was completely untouched. The scandal was bizarre. A company in New Jersey called Allied Crude Vegetable Oil had been borrowing vast sums of money from banks and financial institutions, with American Express's warehousing division guaranteeing the loans. The collateral for these loans was supposed to be giant tanks full of salad oil. The problem was, the tanks were mostly full of seawater, with only a thin layer of oil floating on top. When the fraud was discovered, Allied Crude went bankrupt, and American Express was suddenly on the hook for massive losses, potentially over $100 million, a huge sum at the time. Wall Street panicked. The stock price of American Express was cut in half. Everyone assumed the company was ruined. They believed its reputation was shattered, and its financial business was doomed. Buffett, however, decided to do his own research. He didn't just look at the stock price, he went out and studied the business. He visited restaurants and banks. He talked to merchants who accepted American Express cards and traveler's checks. He observed customers. And what he discovered was that the salad oil scandal, while a huge financial hit to one small division, had absolutely no effect on the company's core businesses. Customers were still using their American Express traveler's checks. Businessmen were still taking clients out to dinner with their American Express charge cards. And most importantly, merchants were still accepting them. He realized that American Express had a powerful moat in the minds of its affluent customers, who associated the brand with prestige and reliability. It also had a powerful network effect with merchants, who had to accept the card because that's what their best customers used. This combination gave the company immense pricing power. Customers were willing to pay an annual fee for the card, and merchants were willing to pay a percentage of each transaction. This fundamental economic engine was completely unharmed by the scandal. Buffett concluded that the market was panicking over a one-time loss and completely ignoring the magnificent, ongoing profitability of the core franchise. He invested aggressively, putting a significant portion of his partnership's capital into the stock. Over the next few years, as the company moved past the scandal and its powerful business model reasserted itself, the stock soared, earning Buffett and his partners a fortune. He saw what others missed. The scandal was a temporary problem, but the pricing power was a permanent asset. The business was so strong it could absorb a massive, idiotic mistake in one division and continue to thrive. The psychology behind pricing power is rooted in the economic concept of demand elasticity. A product has inelastic demand if a change in price has little effect on the quantity demanded by consumers. For example, life-saving medication has highly inelastic demand. People will pay almost any price to get it. A product has elastic demand if a price change has a large effect on demand. For example, if one brand of generic paper towels raises its price, consumers will simply switch to another, cheaper brand. The demand is highly elastic. True pricing power, therefore, is the ability to operate in a market with inelastic demand. But what creates this inelasticity? It's not just about necessity, it's about perceived value and the lack of viable alternatives. This is where psychology comes in. A strong brand, like Apple or Rolex, creates pricing power through perceived value. Customers are not just buying a phone or a watch, they are buying status, design, and a sense of identity. The perceived value is far higher than the functional value of the product, which allows the company to charge a significant premium. A competitor offering a functionally similar product at a lower price is not seen as a perfect substitute. High switching costs also create inelastic demand. If your entire company runs on software from a specific vendor like SAP or Oracle, the cost and disruption of switching to a new system is enormous. Therefore, the vendor can raise its prices for maintenance and upgrades year after year, and you will complain, but you will pay. Your demand is inelastic because the alternative is too painful. A network effect is another powerful source. You use Visa because everyone accepts Visa. Merchants accept Visa because everyone uses Visa. This self-reinforcing loop gives Visa the power to set the transaction fees it charges to merchants. Where else are they going to go? The perceived value is tied to the universality of the network. A business with one of these attributes has effectively insulated itself from the brutal dynamics of price competition. The manager's job becomes much easier. They are not in a constant struggle to cut costs to match a competitor's price. Instead, they are the stewards of a franchise that can dictate its own terms. They can pass on the rising costs of inflation to their customers, protecting their profit margins and the real value of the business over time. This is a critical feature for any long-term investment strategy aimed at achieving financial freedom. To make this concept actionable, you need a systematic way to test for the presence of pricing power. Let's create the pricing power litmus test, a 3-step mental model for your company evaluation process. Step 1. The hypothetical price increase question. This is the single most important question, borrowed directly from Buffett. Ask yourself, if this company raised the price of its core product or service by 10% tomorrow, what would happen? Would customers flee in droves to a competitor? Or would they grumble a bit but ultimately pay the higher price? Be honest in your assessment. For a company like your local electric utility, you'd have no choice but to pay. For a premium brand like Hermes, loyal customers would likely not blink an eye. For a generic brand of milk, you'd probably just buy the store brand next to it. If the company can successfully implement that hypothetical 10% price increase without suffering a major loss of market share, it has genuine pricing power. Step 2. Analyze historical pricing. Don't just rely on a hypothetical. Look at the company's actual history. Has it consistently raised prices at a rate equal to or greater than the rate of inflation? You can often find this information in a company's annual reports or investor presentations, where they might discuss realized price increases. A company that has a long track record of successfully passing on price increases is highly likely to be able to do so in the future. This is a demonstrated, not just a theoretical, competitive advantage. Step 3. Track the gross margin trend. As we've discussed, pricing power shows up directly in the financials. The most sensitive indicator is the gross profit margin. A company with pricing power can protect its margins even when its own costs for raw materials, labor, etc. are rising. It simply passes those costs along to the consumer in the form of higher prices. Look at the company's gross margin over the last 10 years. Is it stable or, even better, trending upwards? If so, it's a strong sign of pricing power. If the gross margin is volatile and trends downwards whenever there is inflation or a recession, it's a sign of a weak, price-taking business. This litmus test provides a robust framework for moving beyond vague notions of a good brand and getting to the heart of a company's real economic strength. The antithesis of a business with pricing power is a commodity business. This is the path of the 99%. Investing in companies that produce something that is undifferentiated and sold purely on the basis of price. A commodity business is a, quote, price taker, not a price maker. Its profitability is entirely at the mercy of the market. Think of a wheat farmer, a copper mining company, or a generic steel producer. The wheat from one farm is identical to the wheat from the farm next door. The copper from one mine is the same as the copper from any other. There is no brand loyalty. There are no switching costs. The only thing that matters to the customer is who has the lowest price. Running a commodity business is extraordinarily difficult. It is the definition of a business that is not idiot-proof. The manager's success or failure depends entirely on two things they have little control over: the market price for their commodity and their ability to be the absolute lowest cost producer. If the market price of copper crashes, even the most brilliant CEO of a mining company cannot save it from losing money. These businesses are often locked in a brutal cycle. When prices are high, they all rush to invest in new mines and equipment to increase production. This new supply eventually floods the market, causing prices to collapse. Then, they all suffer through years of losses, until supply is reduced and the cycle begins again. It is a terrible, unpredictable way to make a living, and an even worse way to invest for the long term. The 99% of investors often get lured into these businesses at the peak of the cycle, when prices are high and profits look fantastic. They mistake the temporary good fortune of a high commodity price for a good business. They fail to ask the simple pricing power question. They don't realize they are investing in a company that has zero control over its own destiny. Buffett learned early on to avoid these kinds of businesses at all costs. He seeks out the price makers, the companies that have a unique product or service that allows them to chart their own course, regardless of the chaotic tides of the broader market. The direct financial connection here is powerful and acts as a shield for your wealth. Pricing power is the single greatest inflation hedge an investor can find. In an inflationary environment, the costs for every business go up: materials, energy, labor. A commodity business, the price taker, sees its costs rise but cannot raise its prices to compensate. Its profit margins are relentlessly squeezed, and the real value of the business is destroyed. The business with pricing power, however, simply turns to its customers and says, "Our costs have gone up, so your price is going up." It acts as a conduit, passing the effects of inflation directly through to the end consumer, thereby protecting its own profitability. This is why Buffett has said that the best business to own during inflation is one that you would buy once, like a brand, that doesn't require continuous capital investment and has pricing power. On the financial statements, this manifests in margin stability and growth. During periods of inflation, you will see the gross and operating margins of a price-taking business collapse. For a business with pricing power, the margins will remain remarkably stable or may even expand. This resilience is the key to long-term wealth preservation and growth. Furthermore, the ability to consistently raise prices drives revenue growth above and beyond just selling more units. This price/mix component of revenue growth is a high-quality, high-profitability form of growth. It allows a company to increase its earnings per share consistently over time, which in turn drives the stock price. When you are performing a financial analysis for your stock market investing, looking for evidence of pricing power isn't just a box to check, it is the central inquiry. It is the search for the financial mechanism that allows a business to not just survive, but to thrive and compound its value through any economic environment, a task so simple that even an idiot manager can be trusted to execute it. Our fifth and final pillar is the most nuanced, the most psychological, and in many ways the most critical for ensuring a business remains idiot-proof over the long haul. It is the absence of the institutional imperative. The institutional imperative is a term Buffett coined to describe the tendency of managers to mindlessly imitate the behavior of their peers, no matter how foolish or irrational that behavior may be. It is the corporate equivalent of peer pressure. It's the urge to do something, expand for the sake of expansion, make acquisitions because other companies are making acquisitions, or diversify into unrelated businesses to create a synergistic empire. This force is a powerful destroyer of shareholder value. It can take a wonderful, simple, profitable business and, under the guise of strategic management, transform it into a complex, inefficient, low-return monstrosity. The truly idiot-proof business is not only structurally sound, it is also embedded in a corporate culture that resists this siren song of mindless action. It is a culture where doing nothing is recognized as a perfectly viable and often brilliant strategic option. The greatest foundational anecdote for this principle is not a single investment Buffett made, but the very structure and philosophy of Berkshire Hathaway itself. Berkshire is the ultimate anti-institutional imperative company. Consider its headquarters in Omaha, Nebraska. It is a tiny office with a couple dozen employees. There is no massive corporate bureaucracy. There is no Department of Strategic Planning staffed with hundreds of MBAs dreaming up elaborate, value-destroying mergers. Buffett and Munger have deliberately kept the corporate center lean to avoid the diseases that plague most large corporations. The institutional imperative at most companies dictates that a large and growing headquarters is a sign of prestige and power. Buffett sees it as a source of unnecessary costs and bad ideas. Now, contrast Berkshire's behavior with that of a typical large corporation. In most companies, a CEO who presides over a shrinking empire, even a more profitable one, is seen as a failure. The pressure is always to grow, to increase revenues, headcount, and the number of divisions. This leads to what Buffett calls diversification, making acquisitions in unrelated fields that the management knows nothing about. Think of the disastrous acquisition of Time Warner by AOL at the height of the dot-com bubble, or more recently, AT&T's ill-fated foray into the media business. These were deals driven by a desire to be bigger, to be transformational, to follow the institutional trend of combining content and distribution. They were not driven by a rational calculation of value. They destroyed tens of billions of dollars in shareholder wealth. Berkshire Hathaway operates on the opposite principle. Buffett and Munger only make an acquisition when they can buy a great business at a sensible price. They feel no pressure to act. In many years they have done almost nothing, content to let Berkshire's cash pile up while they wait for the perfect opportunity. They would rather sit on a mountain of cash earning next to nothing than make a mediocre acquisition at a foolish price. This discipline, this resistance to the institutional imperative, is their secret weapon. It is what has allowed them to protect and compound capital for over half a century. The idiot-proof business, then, is one that either operates in an industry so simple that there are few opportunities for such foolishness, or is run by a management with the rare discipline to resist it. Berkshire itself is the ultimate example of the latter. Buffett has built a structure that is designed to protect the company from the future foolishness of its own managers. The underlying psychological principles that drive the institutional imperative are powerful and deeply ingrained in human nature. The first is action bias. Humans have a strong, innate bias towards action over inaction, even when inaction is the more rational course. We want to do something. A CEO who sits still and simply lets a great business run itself can feel useless. They want to make their mark, to launch new initiatives, to reshape the company. This action bias is often celebrated in our culture. We praise doers and go-getters. But in the context of managing a wonderful business, it can be a deadly sin. The managers of New Coke were victims of action bias. The original formula was working perfectly, but they felt the need to do something to counter Pepsi, and they nearly destroyed their greatest asset. The second principle is the agency problem, also known as the principal-agent problem. In a corporation, the shareholders are the principals, the owners, and the management team are the agents, hired to act in the owner's best interests. However, the agents' personal interests may not align with the principals. A CEO's compensation, prestige, and power are often tied to the size of the company they run, not necessarily its profitability per share. This creates a powerful incentive for them to grow the empire, even if it means making acquisitions that dilute the ownership of the existing shareholders and generate poor returns. This is the agency problem in action. The manager is acting in their own self-interest, building a bigger empire rather than in the interest of the owners, maximizing per-share value. The institutional imperative is the social force that validates and encourages this behavior. When every other CEO is making deals and expanding, it becomes the accepted norm, the smart thing to do, even if the underlying economics are terrible. Buffett's genius is in recognizing these psychological traps and designing a system, both for himself and in the companies he seeks to own, that short-circuits them. He aligns interests by having managers who think like owners, often by making them actual owners through stock compensation and by celebrating rationality over hyperactivity. How can you, as an outsider, detect the presence or absence of the institutional imperative within a company? You need a corporate sanity check, an applied mental model to evaluate the quality and rationality of a company's management and culture. Step 1. Analyze the history of acquisitions. This is the biggest red flag. Go back and look at the company's major acquisitions over the past decade. Were they large, frequent, and often outside of the company's core area of expertise? Did the company pay a huge premium for these acquisitions, resulting in a balance sheet bloated with goodwill? This is often a sign of a management team infected with empire-building disease. Conversely, a company that rarely makes acquisitions, or only makes small bolt-on acquisitions in its core business at reasonable prices, is showing discipline. A history of smart, rational capital allocation is a green light. Step 2. Read the shareholder letters. The annual letter to shareholders is a window into the mind of management. Read them carefully. Is the CEO talking in vague corporate jargon about synergies, transformation, and leveraging platforms? Or are they speaking in plain English about per-share intrinsic value, return on invested capital, and the mistakes they've made? Buffett's own letters are the gold standard. They are clear, honest, and focused on the metrics that actually matter to owners. A management team that communicates with the clarity and focus of a rational business owner is one you can trust. Step 3. Evaluate how free cash is used. This connects back to our second pillar. A company that generates a lot of free cash has several options. It can reinvest it, make acquisitions, pay dividends, or buy back its own stock. The institutional imperative often pushes them towards the first two, even when the returns are poor. A sane management team, on the other hand, will treat the company's cash as if it were their own. They will only reinvest it in projects that promise a high rate of return. If no such projects exist, they will return the cash to the owners. The most effective way to do this is often through share buybacks, but only when the company's stock is trading below its intrinsic value. A track record of buying back stock at high prices is just as bad as a foolish acquisition. A company that demonstrates a flexible and rational approach to capital allocation, treating share buybacks and dividends as valid alternatives to internal investment, is a company that has likely overcome the institutional imperative. The antithesis of this pillar is the classic conglomerate, especially the kind that became popular in the 1960s and 70s. This is the path of the 99%, the belief that a professional manager can run any business and that combining a disparate group of companies under one corporate umbrella will magically create value. These conglomerates were the ultimate expression of the institutional imperative. CEOs were celebrated for the sheer number and speed of their acquisitions. They bought everything from car rental companies to hotel chains to baking companies, creating sprawling, incoherent empires. The idea was that the synergies and the superior management techniques from the corporate headquarters would improve the performance of all the underlying businesses. The reality was the opposite. The management at headquarters rarely understood the specific dynamics of the dozen different industries they were suddenly in. The complexity created a massive, costly bureaucracy. The promised synergies never materialized. Instead of creating value, they destroyed it. Many of these conglomerates, like the infamous ITT under Harold Janine, eventually had to be broken up, with the individual pieces often being worth far more on their own than they were as part of the bloated whole. The 99% of investors and managers are still susceptible to this thinking. They are seduced by the logic of diversification and scale. They believe that bigger is always better. They create complex organizational charts and launch grand strategic initiatives. They are constantly doing undocked, but they are not necessarily achieving. Buffett's approach is a radical departure. He prefers a collection of simple, wonderful, and largely independent businesses. He doesn't believe in the magic of synergy. He believes in the power of letting great businesses run themselves, with minimal interference from a corporate parent. He seeks to avoid the complexity and hubris that defines the institutional imperative, opting instead for a culture of simplicity, autonomy, and rationality. The direct financial connection of resisting the institutional imperative is the maximization of long-term, per-share value. This is the ultimate goal of any investment strategy. A company that avoids dumb, overpriced acquisitions will have a much cleaner and stronger balance sheet. It won't be loaded down with non-amortizable goodwill and massive amounts of debt taken on to finance the deals. This financial strength provides resilience in downturns. More importantly, a rational approach to capital allocation directly fuels the growth in a company's intrinsic value per share. When a company uses its cash to buy back its own stock at a price below its intrinsic value, it's like an investor getting to increase their ownership stake in a great business without having to lay out any additional cash. This is an incredibly powerful and often overlooked driver of long-term returns. It causes earnings per share (EPS) to grow faster than net income. Look at the financial statements and track the shares outstanding number over time. A company that is consistently reducing its share count is a company that is actively making its existing owners richer. A company whose share count is constantly rising is a company that is diluting its owners, often to fund the ego-driven acquisitions of its management. Furthermore, a disciplined company will exhibit a consistently high return on equity (ROE) that isn't being artificially manipulated by taking on excessive leverage. The profitability is genuine, generated by the quality of the underlying business, not by financial engineering. In the end, the absence of the institutional imperative is a cultural and psychological advantage that translates into superior financial performance. It ensures that the wonderful economics of a great business are not squandered by the foolish, trend-following behavior of its managers. It is the final, crucial element that locks the door of the fortress, ensuring that the business is not just idiot-proof from outside competition, but also from the enemy within. You have just completed a deep dive into one of the most powerful mental models in the world of finance and business. You have acquired the idiot-proof business test. You no longer just see a company's logo or its stock price, you see its skeleton, its engine, and its armor. You can identify the indestructible moat that protects it. You can verify if it has a self-fueling engine that gushes cash. You can assess the predictability of its customers. You can test the potency of its pricing power. And you can spot the rare corporate culture that has the wisdom to leave a wonderful business alone. This framework is a powerful tool for any investor, entrepreneur, or executive who is serious about building or owning resilient, long-term assets. But this test, as powerful as it is just one critical tool in a multi-layered system of executive decision-making that constitutes the genius of value investing. Knowing what to buy is only half of the equation. The other half, the part that separates the good investors from the legendary ones, is knowing when to buy. You can identify the greatest, most idiot-proof business in the world, but if you pay too high a price for it, your returns will be mediocre at best. The entire system is built on a network of interconnected mental models, and you have just mastered a crucial foundational piece. The next piece of the map, the principle that links the quality of the business to the price you pay, is what Buffett considers the three most important words in investing. The video that is now appearing on your screen is not a random suggestion from an algorithm. It is the missing link. It is the logical next step in your journey. It holds the key to the other side of the value investing equation, the foundational principle of the margin of safety. It is the discipline that turns a great business into a great investment. It is the part of the system that protects you from the one thing you can never predict, the future. For some people, this is where the journey ends. They have learned a fascinating concept, and that is enough. But for those of you who are truly committed to building a robust financial future, for those who understand that success is built layer by layer, the choice is not just clear, it is necessary. To stop now is to leave with an incomplete weapon. The click is not about watching another video. It is about continuing your ascent, complete your mental arsenal, master the entire system. Click the video and take the next step.